In the fall of 2025, the Social Security Administration sent out a piece of news that sounded like good news: a 2.8% raise, coming to nearly 71 million people in January 2026. If you're one of them, or you will be one day, you probably did what most people do when a number like that shows up. You did the quick mental math. A couple $1,000s a month times 2.8%, that's an extra $50, $60 landing in your account every month starting in the new year. For a lot of people, that's roughly what happened. But for millions of others, something strange happened instead. The letter said 2.8%. The math on paper said more money. And then the actual deposit hit their bank account, and it was the exact same number as the month before. Not close to the same, identical, down to the cent. No typo, no mistake by the bank. No one forgot to update the system. Their raise didn't get smaller, it got erased. And the reason it happened has nothing to do with inflation or politics or the solvency of the trust fund people love to argue about online. It has to do with a piece of Medicare math that's been quietly running in the background of the Social Security system for decades, and it happens to hit hardest the people who can least afford it. By the end of this video, you're going to be able to look at your own benefit amount and know with actual numbers whether your 2026 raise survives contact with Medicare or whether it gets wiped out completely. So let's start with the two people this actually happened to. Robert is 68. He spent 31 years as a mechanical engineer, retired at 66, and now draws a Social Security check of just over $2,000 a month. When his COLA notice showed up in December, it said his benefit was going up by about $56. He opened his bank statement in January, and there it was, $56 more, minus a little for the new Medicare premium, netting him about $38 extra a month. Not life-changing, but real. Diane is 71. She spent most of her working life as a part-time bookkeeper, took years off to care for her mother, and later drew a modest benefit based partly on her ex-husband's earnings record. Her monthly check is $600. When her COLA notice came, it said the same thing Robert's did, a 2.8% increase. On paper, that's about $17. Diane never saw that $17. Her January deposit was exactly the same as her December one. Same COLA, same percentage, same government program, completely different outcome. And once you understand why, you'll never look at a COLA announcement the same way again. Here's the piece almost nobody explains clearly. Social Security and Medicare are wired together. If you're on Medicare Part B, and most retirees are, your premium usually doesn't get paid separately. It gets pulled directly out of your Social Security check before the rest of it ever reaches your bank account. Your raise and your premium increase are racing each other inside the exact same envelope, and every year, the outcome of that race depends on the size of your check. For 2026, Medicare Part B's standard premium went up by $17.90 a month, climbing from $185 to $202.90 a month. That's close to a 10% jump in the premium, on top of a 2.8% jump in the benefit. Those two numbers moving at wildly different speeds is exactly where this whole story starts. Now, for years, Congress has understood that this mismatch could actually make people's checks shrink. Imagine if the premium simply rose faster than your benefit did. Your net check could go down year over year in a program that's supposed to protect you from losing ground. So back in 1988, lawmakers built in a safeguard. It's called the hold harmless provision, and its entire job is to make sure that most existing Medicare enrollees never see their net Social Security payment decrease from one year to the next because of a Part B premium hike. That sounds like it should be purely good news. And for people like Robert, it basically is invisible, because his raise is big enough in dollar terms to absorb the premium increase and still leave money on the table. But Hold Harmless doesn't guarantee you keep your raise. It only guarantees your check doesn't drop below what it was before. Those are two very different promises, and the gap between them is exactly where Diane's raise disappeared. Watch what happens to her numbers specifically. Her benefit is $600. A 2.8% COLA on $600 comes out to $16.80. The standard Medicare premium is rising by $17.90. Her raise is smaller than the premium increase. If the full premium hike were applied to her, her check would actually go down by $1.10 compared to last year, which is exactly what Hold Harmless exists to prevent. So the system does what it's designed to do. It caps her premium increase at $16.80 instead of the full $17.90, protecting her from a net loss. Her check doesn't fall, but it doesn't rise either. Every cent of her raise gets absorbed, dollar for dollar, into a Medicare premium that used almost all of it just to keep her flat. Robert's math runs completely differently, and this is the part worth sitting with, because it's not really about Robert and Diane specifically. It's about a threshold that applies to everyone on Medicare Part B. If your COLA dollar amount is smaller than the premium increase, Hold Harmless kicks in, and your raise gets swallowed. If your COLA dollar amount is bigger than the premium increase, you keep what's left over after the premium takes its cut. You can actually find your own personal break-even point right now with one piece of arithmetic. Take $17.90, the 2026 premium increase, and divide it by your COLA percentage, 2.8%, or 0.028. That comes out to roughly $639. If your monthly Social Security benefit before the 2026 increase was below that number, there's a real chance your raise got fully or mostly absorbed by Medicare. If it was above that number, you likely kept some or most of it, just like Robert did. $639 sounds like an oddly specific, almost trivial number until you realize who tends to fall below it. It's rarely someone who worked a full career at a solid salary. It's much more often someone drawing a spousal benefit, a survivor benefit, a benefit based on a shortened work history, or a benefit that was reduced because they claimed early out of necessity rather than strategy. Disproportionately, that's women. Disproportionately, that's people who spent years as caregivers instead of employees. Disproportionately, that's the people already living closest to the edge of what their check can cover. This isn't a one-time glitch tied to 2026. It's a pattern that resurfaces almost every single year because the two numbers driving it, COLA and the Part B premium, are calculated by two completely different formulas that have no obligation to move in sync. COLA follows a measure of general consumer prices. The Part B premium follows Medicare's own projected spending, driven by things like prescription drug costs, physician fees, and outpatient care trends. Some years, those two numbers happen to move together nicely. Other years, healthcare costs sprint ahead of general inflation, and anyone with a modest benefit gets caught in the gap. There's one more twist worth knowing, because it changes who Hold Harmless actually protects. The safeguard only applies if your Part B premium is already being deducted directly from your Social Security check, and if you were already enrolled the year before. If you're a brand new Medicare enrollee in 2026, Hold Harmless doesn't cover you at all because there's no prior year's deduction to hold you harmless against. You simply pay the full $202.90 from day one. And if your income is high enough to trigger the Medicare surcharge called IRMA, Hold Harmless doesn't apply to you either. It was built to protect people with modest, steady, already enrolled situations, which is a narrower group than most people assume when they hear the word protection. So where does that leave you? Sitting here with your own benefit statement somewhere in a drawer or a folder on your phone. If your number is comfortably above $639, this video is mostly a piece of context, useful for understanding a program you're already inside of. But if your number is close to that line or below it, there's something worth doing this month, not eventually. Log into your personal My Social Security account and look at the actual COLA notice. Not the percentage in the news headline, but the specific dollar figures for your benefit and your new premium. That single document will tell you in black and white exactly what's happening to your check in January, instead of leaving you to find out by comparing bank statements after the fact. It's also worth knowing that this dynamic barely touches people who get their Part B premium paid a different way, for instance, through a Medicare Advantage plan structured differently, or through Medicaid assistance programs that cover premiums for lower-income beneficiaries. If you suspect you might qualify for a Medicare savings program, that's a conversation worth having with your state's Medicaid office, because it can effectively remove you from this whole tug-of-war entirely. There's a broader lesson sitting underneath Robert and Diane's story, and it has nothing to do with Social Security specifically. Two people can receive the exact same percentage increase in income and end up in completely different financial positions because percentages don't tell you what's actually happening to your money. Dollars do. A 2.8% raise on a large number is a real gain. A 2.8% raise on a small number can be erased by a single fixed cost that doesn't care what percentage anything moved by. That's worth remembering well beyond this one Medicare quirk. Every time a raise, a return, or a rate gets announced as a percentage, before you celebrate or panic, translate it into dollars, and then compare those dollars to whatever fixed cost might be waiting to eat into them. That habit will serve you in far more places than just your COLA notice. Diane's check didn't shrink this year. In a strict, technical sense, the system worked exactly as designed. But she also didn't get the raise she was told she was getting, and nothing in the announcement she received made that distinction clear. The 2.8% was real. It just went somewhere other than her pocket. If this is the first time you've seen the actual mechanics behind that gap, you're already ahead of most people holding a COLA letter right now. Go find your own number, run the divide, and you'll know exactly which side of that line you're standing on.